Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Egon von Greyerz, Managing Director of Matterhorn Asset Management in Zurich. Egon, welcome to the Keiser Report.
Thank you. Great to be here.
All right, Egon, we've just had some pronouncements from Janet Yellen and the Fed. There's always an interesting connection between what she says and the price of gold, which, of course, is your specialty. Maybe just open this up a little bit by talking a little bit on this.
Yes, well, Janet Yellen is not going to change anything from what Bernanke did. I mean, they are the biggest money creators in the world, the Fed, and they will continue to do so. Okay, short term, so she had to continue with tapering, but that won't last. And actually, the influence of the Fed announcement on gold, the last 6 times I've gone back and seen gold goes down every time, and often quite substantially around the Fed announcement. And then in the last few months, it's gone back up every time again. So it's a good trade going short before the Fed announcement and then buying back again.
Okay, you just said something there. You said tapering won't last. Now, just to remind people what tapering is, I mean, the quantitative easing was this idea of the Fed buying back all these bonds, it's effectively monetizing the debt. Now this has gone on for a while. People are asking, when are they going to get out of this quantitative easing? And the word used is taper, by they're buying less on a monthly basis. But they're saying that they're possibly going to stop quantitative easing. And she said within 6 months after that, interest rates would go higher. You're saying no tapering, absolutely not. Talk a little bit about this.
Well, the Fed lives in a dream world. They believe that, like the president, that the U.S. economy is booming and that things are going to get only better. It won't happen. The U.S. economy is bankrupt. It will continue to be bankrupt. They need to issue unlimited amounts of money to survive. And of course, printed money will never create wealth, so they won't survive with that either, but they will just kick the can down the road. So the Fed will continue to print money. That might be tapering for another couple of months, but thereafter there will be events that will necessitate the Fed printing money at an accelerated rate, in my view.
How would you compare, let's say, what's going on in the Fed, the United States, and the Bank of England here in the UK? Obviously, they have a new chairman, Mark Carney. They've come out with their recent budget discussions. It appears that with programs like the Help to Buy scheme, which is a way to underwrite the real estate market, like the Fannie Mae in America, it's very similar to the U.S.
Very similar. There are 2 areas of the UK economy that are booming. One is behind us here, the city. Everyone is rich in the city because if you have money, you can make money because every central bank in the world helps you to print money and therefore to trade with money and to make very nice returns on the money. The other market, which is prospering, is the housing market. You cannot have an economy based on finance and on people buying houses, especially now with no money down and subsidized interest rates. So the UK consumer is borrowing, the US housing market is booming. That won't last either.
Okay, Egon, basically, correct me if I'm wrong, but over there at Matterhorn Asset Management in Switzerland, the firm that you run, that you're the chairman of, the goal is wealth preservation, and the medium for this is gold. So gold not necessarily for a trade, gold not as an investment, but gold as wealth preservation. What does that mean? Talk a little bit about that.
Yeah, well, we decided already 12 years ago in 2002 that the world was going to be in a mess and that it was absolutely essential to preserve wealth. So we told our clients that we even set up to 50% of their financial assets into the physical gold.
Okay, so that's a very, let's say, aggressive recommendation, because typically people would say put 5% into gold. But your firm, back when gold was at $250, $300 an ounce, you said up to 50% in gold.
Yeah. So obviously everybody didn't put 50% in. We have clients who have 100% in gold almost, and we have clients who have 5 or 10. So, but nevertheless, we saw that the destruction of paper money was going to accelerate. So it was, for us, you buy something when it's unloved and undervalued. And at that time, gold was both unloved and undervalued. So it was pretty easy. Now, governments will, as they have done throughout history, continue to destroy the value of paper money by printing unlimited amounts of it. And so they have been doing, they're still doing it. Bernanke, during his period as chairman of the Fed, the debt of the United States of America went from 8 trillion to 17 trillion. So he created more debt in his 7 years than it took the U.S. to create for over 200 years. They went from 0 to 8 trillion over 200 years, and he created 8 trillion in just over 7 years. Yeah, that will continue. Yellen will continue also. They can't do anything else.
All right,
they're running budget deficits. They've run budget deficits for over 50 years. They're running trade deficits for the same period.
Right, and it seems like everything's tied to this idea of interest rates being near zero in perpetuity, which is kind of a crazy bet. But before I talk about interest rates, I wanted to throw something out at you and see what your response is. Basically, people talk about the price of gold, and they fixate on, it's 1900, it's 1500, it's 1300, and they really focus on price. I want to introduce this concept, price versus availability. The idea here is that when the time comes when you really need your gold because of the banking system collapse from all this shenanigans, there might not be gold available for you at any price. If you know what I'm getting at. In other words, there's issues in Switzerland and around the world where people are going to collect their gold from the bank. And your service, by the way, is not a bank; it's a vault. Big difference. And it's not there. So here's my topic: price versus availability. Take it away.
Yeah. Well, you know that the paper market in gold is about 100 times the physical market. We live in a paper world today. Everybody believes in paper. But sadly, the paper gold holders will not get any gold. And when the problem starts in the economy, and they will do, and people start worrying about the fact that the bullion banks have no gold, the central banks don't have anywhere near the gold they say they have, and people start then saying, I want delivery, they won't get gold. They'll get money, maybe, if they're lucky. And COMEX will not be able to deliver either, the futures market we're talking about.
Bullion banks, HSBC, JP Morgan.
Correct.
And others. You're saying they don't have the gold they say they have.
Exactly. They don't have the gold, and the central banks certainly don't have the gold. They said they're supposed to have 30,000 tons. I don't think they have half, even less. I mean, everybody in the gold market knows that the Fed has not had an audit since Eisenhower's days of their gold.
And it's in Asia.
It's in Asia because what happened, especially when gold fell last year, which is, I'm sure you've been through this before, when gold fell last year, this was manipulated, the fall of the gold price, so that the bullion banks could fill up their vaults. What happened instead is that, because normally the bullion banks, when they buy and sell, the gold stays with them. The buyer and the seller is always with them, central banks, the ETFs, etc. As it happened now, the Chinese bought all the gold that actually became available.
And Russia.
And Russia also.
Let me ask you this quick on a geopolitical front. It seems like on the geopolitical equation, you've got now Russia, China are kind of siding up against, and we'll call them the oil and gold and gas powers versus the paper powers of the U.S., the U.K., on that other side. So it's gold versus paper in this currency war, as you could call it. Over the last few years, during the price fall, China and Russia have been aggressively buying gold. Are they now in a position where they can reject the U.S. dollar as global reserve currency and strike out on their own? And is that part of what we're seeing in these global tensions?
Absolutely, in my view. I mean, the dollar does not deserve to be the reserve currency of the world, sadly. Coming from Switzerland, when I started working in Switzerland a long time ago, 1970 roughly, the Swiss franc to the dollar, it was $1 for Swiss francs 30. Today, it's about 88 cents. That's a fall of 80%. And only in the last 12 years, the dollar has gone down 50% against the Swiss franc. The dollar is on the road to perdition, sadly. But it's, you cannot run all these deficits that I just mentioned and consistently overspend and spend what you don't have and print money and at the same time be the reserve currency of the world. So yes, the dollar is on its way now, and they're trying to support it at various points. But the dollar is on its way now to crash. All currencies, of course, are going down to their intrinsic value of zero, but the dollar will be the first one. So I believe it's only a matter of time before, as you say, China, Russia, etc. First, I mean, the wonderful weapon that Russia has now is just to stop using dollars altogether in the Ukraine and Crimea battle here. And of course, that will hurt the US more than anything else. So, never mind all the sanctions they're trying to...
We've heard about currency wars.
Yeah.
So you're saying that in the currency war, or let's call it a big poker game, Russia and China are holding 3 aces when they're gold, and then the U.S. has got a pair of 2s.
Absolutely. And especially because they have a very weak currency that is overvalued because the whole world is trading in it. But once they stop trading in it, and I think China and Russia will be the first countries to stop trading in it.
Well, they're doing a lot of bilateral deals now.
Yeah, already.
Brazil, other BRIC nations, a lot of bilateral deals. I want to talk about this idea of manipulation for a second, because it's a contentious topic. But one area that we know, without a doubt, we see the manipulation happening, and that is when we see it almost every single day. The price of gold in Asia is up overnight because people in Asia are buying gold. They realize this paper money empire is about to collapse. And then when the price hits New York, hits COMEX, you see a big dump almost every single day. To me, that's a clear sign of manipulation. It's not price discovery, it's price manipulation. Your thoughts?
No, there's constant price manipulation, and especially you can see it happening because it's always in the thin market, and the trades are always crazy. No one would dump the amount of gold, or in this case, paper gold, of course, it's never physical, that they dump when they manipulate, because they're just, you'd lose a fortune every time you do it. So the manipulation, there are many people, Chris Powell of Gata and others who are, more experts in this than I am, but it's absolutely clear there's manipulation. Because why do they do it? Well, because first of all, because they haven't got the gold that they have, so they actually, need to get the price down. And secondly, gold reveals the bad management of the economy, and that's why they want gold down. So, but I have a very firm view that manipulation only lasts short term. In the long run, the real market will win, and in this case, gold will win. They cannot, they haven't. In the last 14 years, we've gone from 250 to 1330 today. That trend will continue. Because all it does is to reflect the destruction of paper money.
All right, fair enough. Egon von Greyerz, thanks so much for being on the Keiser Report.
Okay, it's a pleasure to be here, Max. Thanks very much.
And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Egon von Greyerz of Matterhorn Asset Management. If you'd like to get in touch, tweet us at Keiser Report. Until next time, bye, y'all.